Greetings, everyone. My name is Ignacio Neri, and I am from Mexico. I am currently poised to complete the Master of Science program in Sustainability Management at Columbia in early July. And upon completion, I am excited to join Verdonck Partners, an investment banking boutique with a specialized focus on transitioning the energy and infrastructure industries. In this spirit, and along with the support from the Columbia Climate School, especially from Adrian Kenyon and Omar Herrera, from Verdonck Partners and its founder, Patrick Verdonck, and from Colombia's Environmental Entrepreneurs Club, we curated the Climate Finance Solutions for Latin America webinar, where we will delve into the present issues surrounding the considerable climate financing gap in Latin America and the Caribbean. This region, one of the most indebted worldwide, is currently grappling with a trifecta of economic shocks. The pandemic's hit on the GDP, supply upheavals from the Ukraine war, and the impact of the Fed's interest rate hikes. Each country within this diverse region presents unique risks and untapped job opportunities. Today, our focus will be on how development finance institutions, DFIs, can contribute tangible solutions addressing the region's specific needs and potentials. We'll explore propositions such as substantial transfers from developed nations, guarantees, and innovative debt for nation swaps to preserve the region's rich natural capital. We will also address the indispensable role of private capital mobilization. Thus, our dialogue today aims to turn discourse into decisive action. With that in mind, it is my pleasure to introduce you to our esteemed panel for today's discussion. Starting with Helen Meirovich, the head of climate change at IDB Invest, based in Washington, D.C., boasts a career spanning over 16 years in climate roles within the IDB group. Her track record includes recently closed transactions such as deploying drone technology in agribusiness for pest management, climate risk analysis for infrastructure projects, and driving sustainable finance and green bond certifications for banks. She also helms the Think Sustainable Network, a congregation of financiers, investors, and insurance companies investing in the Latin America and Caribbean region. Specializing in creating environments conducive to climate investments, Helen works closely with public and private sectors to develop and integrate climate action and strategies, further attracting international funds for climate initiatives in Latin America and the Caribbean. She was awarded the Ortiz Mena Award for an innovative loan operation that amalgamated fiscal and climate adaptation measures. A political scientist from Universidad Católica de Córdoba, Argentina, Helen holds a master's degree from the Hebrew University, Israel, and a master's degree and PhD from Georgetown University. Continuing with Marcela Ponce Perez, she's an esteemed figure in climate finance solutions. With over 9 years at the IFC, she currently spearheads their climate finance initiatives in Latin America and the Caribbean. Marcela's journey began as an architect, transitioning into finance and sustainability, earning her an MBA from the Southern New Hampshire University and a Master of Studies in Sustainability Leadership from the University of Cambridge. She is also a certified expert in sustainability and climate risk from Global Association of Risk Professionals. Her rich educational background and practical experience make her an invaluable resource for tackling climate change challenges through financial lenses. Continuing with Daniel Buckley, he's a seasoned professional in climate change policy and finance with over 15 years of experience across United Nations agencies, multilateral banks, and financial institutions. He currently serves as Senior Climate Policy Advisor at the U.S. International Development Finance Corporation, advancing their climate action plan. Previously, Daniel managed a significant portfolio with the Green Climate Fund and led a high impact program in Vietnam for the Global Green Growth Institute. He is also recognized for his valuable contributions to the UNDP. Armed with a master's degree in public administration from Columbia University, Daniel is well versed in assisting public and private sectors to achieve sustainable development goals. And finally, Dr. Satjayit Bose, who is a respected sustainable investing expert, data scientist, and currently a professor of practice at Columbia University. With a deep academic and practical background in sustainability management, Dr. Bose brings his expertise from a range of roles, from building quantitative trading strategies at Aristeia Capital to steering a luxury retailer through the financial crisis. As an independent consultant, he has co-founded a weather risk management consulting firm and offers insightful guidance in sustainable investing. He has designed and taught notable courses at the Sustainability Management Program at Columbia on climate finance, sustainable investing, cost-benefit analysis, and economic growth, leveraging his PhD in environmental economics from Columbia University. Today, we look forward to his invaluable insights on climate finance solutions in Latin America. I give the floor now to Dr. Bose, who will be moderating the discussion. At the end of the panel, our panelist and moderator will be answering your questions, so please share them with us on the Q&A menu. Thank you very much.
Thank you, Ignacio. It's a pleasure to be moderating this distinguished panel of experts. I'm sorry that my greetings to everybody are not in Spanish, but in this gringo language. You know, although I don't speak Spanish too well, I do think that I'm Latin American because you know, it is said that we are what we eat. And I, you know, I only like to eat Latin American food. So at least from the inside, I'm Latin. But anyway, let's chat about this. I think, you know, I want to showcase our experts here and give them a chance to share their knowledge. And I think the first question, which I get a lot, especially from private investors, both investment managers and asset owners, you know, there's a lot of talk about private-public partnerships to meet the goals, the climate financing gap, which Ignacio mentioned, or the SDG financing gap in developing countries, in Latin America, definitely. How can private investors, you know, how can asset owners, how can asset managers, funds, how can they collaborate with the DFIs in order to scale up the amount of climate finance needed for the region, given the big gaps? And what are the challenges that you see, and what are the examples of working together? So it's kind of a big open-ended question, and maybe we can just go through each of you and your take on it. So I'll just go in the order on my screen. Marcela, do you want to start?
Sure, absolutely. Well, first of all, thank you so much for the invitation to be in this panel. And it is a pleasure to share this panel with Daniel and Helen, who I haven't seen in a long time. So let me start with something that we believe is very important, and with a clarification before my answer. I am focused on financial institutions specifically, and therefore my view over the topics that you have proposed could be a bit limited. But in general terms, for climate finance, one of the things that we have identified for a long time is that standards are fundamental so that the market could move towards climate finance in general, in any sector. So saying that, I think that one of the most important things that we are seeing in development in the region is the standardization of what's green, what's a green economic activity. And that includes infrastructure, that includes manufacturing activities. And we are seeing in the region the green taxonomies, which are tools that are aimed to facilitate precisely that. So taxonomies is one of the areas where we have been working on from IFC in the region. We have worked in Colombia, Mexico. Those two countries we have already launched the green taxonomy and sustainable taxonomy respectively. And we are working in other 8 countries in the region to develop these green taxonomies. On the other hand, particularly for PPPs, for public-private partnerships, one of the things that we have seen is that it is important to include these climate-related criteria in the regulation or in the guidelines that are issued, or the requirements that all these projects have when they go out to the market on the bid. So I think those, for me, would be the most important pieces of all the sectors. And let me go back again, because that's not my sector, but in general terms for any other sector, that would be the fundamental pieces so that the sectors become greener or more climate responsible.
Yeah, thanks, Marcela. Really glad you pointed out the importance of standards and taxonomies, and also in the case of infrastructure and PPPs, the climate-related criteria. I think Helene probably has a lot to say on this, right? Because we talked about your bond, green bond certification and standards. So maybe Helene, do you want to jump in?
Yeah, just to confirm, you can hear me?
Yes, we hear you.
Okay, super. So no, thank you so much for the question, for the invitation, and for having this space to talk about climate finance, which is a passion of ours, I guess, with working every day on this. So I will complement Marcela, because she already mentioned 2 very important key issues, but I think there are other issues when we talk about private investors that are trying to increase their investment in climate finance. One of the issues is generally they will tend to understand climate finance as mitigation, right? So they will associate it immediately with renewable energy. You know, when you talk to the BlackRocks of this world and you say, oh, you have a climate program, what are you looking for? They will immediately go into green projects that for them, it's equal to mitigation, to wind farms or to solar farms. So I think that one way is also increasing awareness within all these funds. Not all funds are equal, not all the roles are the same. So we are seeing some funds that we are investing in the region where we actually support them to adopt TCFD as a fund. And with the adoption of TCFD and supporting them with the financing or investing in the fund together with the technical assistance to develop the TCFD framework, they will start understanding that they have to have targets, that they have to have a governance, they have to have a reporting and understanding the climate risks that their own investments later on may have and how to manage those risks. So one thing is to talk to fund managers or anyone that is having an idea of doing a climate fund, a green fund in the region, that they should be using those frameworks, the taxonomies that Marcela was talking about, together with TCFD or, more recently TNFD, to include not only climate, but also biodiversity and nature positive investments. That would be one thing. But then you have the others that are trying to look for investments in the region, at least in Latin America. And what we have seen together with our mobilization teams is that many times they want good assets. They're not necessarily looking for green assets. They want good assets. And to everybody's surprise, right now, IDB Invest, 60% or 70% of what we mobilize are green assets. It's because they're good assets to invest in. And so understanding that sometimes, they see it as a cherry on the cake, but at the end of the day, it makes business sense to invest in green projects. I think that's a very powerful way to attract and to bring investors to the table. So I'll stop there, but we can continue the conversation. Thank you.
Helene, that's really interesting, and because you ended with, green assets are good assets, right? And I want to throw this to Daniel now, because Daniel, you were at the Green Climate Fund before. You were at the Global Green Growth Institute, and now at DFI. Your role is on focusing on climate finance. So can you maybe talk a little bit about that? Why are green assets good assets?
Sure, happy to. Thanks very much. And thanks as well as inviting DFC to speak today. For those who don't know, DFC is a new agency. We were created in 2019 and operationalized in 2020. We replaced the Overseas Private Investment Corporation, but this is the first time that the US has put out essentially what is a development bank. And so our development mandate is one that is sort of new, and OPIC focused primarily just on private investment overseas. But of course, we do have to balance a development mandate with a US foreign policy mandate and supporting our countries along those lines. Yeah, you're right. I worked with Green Climate Fund. I worked with GGI, a lot of green in my former employer's place name. And green assets are good assets. And I'll probably take this from a slightly more policy perspective, given my background. And I think it's important to highlight that two additional things that haven't been touched on yet in terms of why a green asset makes a good asset, and why are green assets actually sought after in the market. And it's a couple of things. We have this momentum finally convened under the auspices of the UNFCCC and the Paris Agreement, which everyone is probably familiar with. And countries are putting together their nationally determined contributions, which are meant to sort of give a whole of government approval and path of travel for investment related to climate change across mitigation adaptation in the entire country. And one of the things that we come up against sometimes at DFC, because again, we are entirely focused on private sector investment. We do not invest in public agencies at all, public agencies or institutions. Is the question is, well, how is this furthering the country's NDC? How is this furthering the country's national adaptation plan or any one of its sectoral strategies on energy, agriculture, or transport? And because we have recognized not only is that a necessary component of our bilateral relations with any given country as an entity of the US government, but also because we recognize that these are the sectors, these are the areas of prioritization that governments themselves are putting their own domestic incentives behind. And that's particularly something that's relevant for our investment partners that are not based in those countries, the funds and facilities that are working on a regional global basis, that they need to understand that beyond the concessional capital that they can leverage from DFC, there are also additional domestic incentives to invest in these priority areas. The second question I think that's quite important that we ask investees coming to us is what's the additionality argument for DFC as a DFI to become involved here? Harking back to my time at Green Climate Fund, where we provided plenty of grants, highly concessional capital in loans, equity, and in guarantees. There came a time towards the end of my tenure there where we stopped grant financing renewable energy basically anywhere in the world, and that included Afghanistan. And because the argument was quite simple, there is no need for a GCF to come in and play that role. However, I think in areas that Hélène has mentioned in adaptation, there is a huge need for additionality of concessional capital. And I think that's another area where you kind of need to peel back the layers of the onion to understand that that asset is a green asset, first of all, by making it more climate resilient, making it adaptable to the expected shocks of climate change. But it's also just an underlying solid asset because it is increasing economic livelihood. It's saving wealth of the surrounding population from being at risk from climate shocks. And so these are other reasons why these green assets are truly good assets for investors.
That's great. Thank you, Daniel. So let me kind of draw some of what you've all been talking about. Hélène, you talked about adaptation, and Daniel sort of brought that up. Marcella and Daniel, you both talked a little bit about domestic mobilization. So to what extent can I, if I'm a sort of US-based investor or a Europe-based investor, and I'm thinking about how do I get into projects or enterprises, investments, it could be financial institutions, that essentially have buy-in domestically, which means that I should expect to see co-investment by local investors or local tax incentives or local policy helping out. These are all essentially forms of domestic mobilization. How do I identify those types of projects? To what extent can the DFIs help? Is there a process where the funds are being helped, let's say, with adopting TCFD certainly or TNFD, but also understanding the alignment with the local NDCs and therefore the local buy-in? How do I make sure that whatever I'm investing in has shared value domestically? So any of you guys, I can maybe, Marcela, do you want to jump in? Even from a financial institution perspective, supporting
Sure.
local financial institutions.
No, absolutely, absolutely. One of the programs that we have in IFC is precisely the development of capital markets. And through the development of capital markets, we are trying to do a couple of things. One is to create clear guidelines in terms of what a green instrument is. So it is absolutely clear for European investors or American investors that the requirements that they need for an investment like this are there, right? So we work with the stock exchanges, we work with supervisors of capital markets to create this kind of standard so that these markets are more attractive to international investors. Now, if you look at the green bond, or let's say the thematic bond issuances in these countries, which is not a big market, what you can see is actually a very good blend between international investors and local investors. And we have seen very good examples of a perfect mix between these. Those bonds are normally listed, and that in a way provides some kind of transparency, if you want, for international investors. But we have also seen private placements that work very well where international investors also co-invest in this type of instruments. So I guess that in terms of what is the attractiveness of that, I would say that if the standards and locally are clear, then it could become very attractive to international investors as well as local investors. Now, we as multilaterals, as development banks, obviously have provide a kind of a stamp of approval, if you want. Once a multilateral is in a transaction, then other investors feel more comfortable. And that applies to both local investors or international investors in a way. And that means that we are basically applying best practices. And I think that's the cue, probably, for the development of the capital markets, that these best practices are not only multilaterals best practices, but that they become local practices and business as usual practices. And that's what we are trying to do in the capital markets by implementing or incorporating particular requirements to the issuance of, for example, thematic bonds.
That's great. That's very interesting. Helen, do you want to jump in as well?
Yeah, I mean, I wanted to compliment because when you started talking about domestic mobilization, I thought about domestic capital markets, but then in the explanation that you gave, you also basically said, how international investors are sure that their investment is in line with the policies that are in place. And I think that that's a very important question as well. And part of the conversation that we're having most of the MDBs right now, and I think we are right now since January 1st doing Paris alignment assessment of all our transactions. 100% of our transactions need to be Paris aligned. I think IFC starts now in July, right? Or June, July, I think. So what does that mean and why do I bring it up? Because the way all of us MDBs think about Paris alignment and how are we choosing or saying that a transaction or an investment is Paris aligned is based on the NDCs, is based on the long-term strategies of the country, is based on the sector approach that the country has. Because we are MDBs, we based our definition of Paris alignment not only on the global commitment of 1.5 degrees, but we complement the methodology with what is defined as the NDC in that country and the long-term strategy of that country, which also gives that very strong signal that that specific project is aligned with the policies of the place. So I just wanted to say that in addition to what happens in capital markets, we're having this new arrangement or this new process to make sure that what we're supporting is Paris aligned.
Yeah, no, I think you make a very good parallel there, because it's important to connect the domestic mobilization both to capital markets and to the creation of local value, which leads me to a question for Daniel, because so if I think about investments in emerging markets, the biggest issue always is the political risk. The sovereign risk has this political risk component. That's probably the highest component of the basis point risk premium, right? And so if I think about that, if I take a step back and I say, look, if we are using the financing to fund projects which are of broad and demonstrable value to the local population, it makes it highly less likely that a change in government or a change in policy would derail that project, right? So if the project is adding value to the local population, if it's aligned with its policies, with the NDC, with the NAP, the adaptation plan, then it's that much harder for these things to get derailed. So Daniel, do you find that in terms of political risk, I'm not sure that this necessarily applies in terms of quantitative risk premiums for insurance, but do you find that the more aligned projects, the Paris aligned projects that Helen is talking about, those are likely to or should receive a lower risk premium?
Yeah, I think I would largely agree with that. As we discussed in our call this week in preparation for the session, one of the most powerful mechanisms that DFC has deployed for climate finance is the political risk insurance tool. It's one that is not deployed by other DFIs other than the Multilateral Investment Guarantee Agency and then the private market. And they have, private market has a lot less appetite for getting involved in certainly resilience and adaptation infrastructure types of investment. And it's limited when it comes to the more sure bet kind of projects in renewable energy and in resource extraction. And in fact, DFC just undertook a review of or an evaluation of its PRI portfolio. And I think out of like the 25 case study projects that they looked at as stellar examples, at least 50 to 60% of them were some sort of climate deal in solar, wind, resource extraction, energy generation, or something like that. But that's a double-edged sword, right? Because it means that yes, while it is a powerful tool, these are still sectors that are at risk of expropriation, incontrovertibility, or some of these aspects. However, it's also found to have an incredibly powerful leverage ratio for us. I think as I was looking over the details, we have a portfolio of approaching $8 billion on PRI total. Again, a majority of that is in climate relevant sectors, and a full third of that has been ceded to private reinsurers. So already, getting back to Marcela's and Helena's point about sort of the DFI stamp of approval, we're seeing that certainly in the instances of the PRI tool. And also on top of that, I think the other thing to remember is that, yes, okay, fine, great. It mobilizes additional private sector investment. That's sort of the reason for being of a DFI like DFC. But the analysis that we conducted also looked at the second order effects of PRI, strengthening institutions, improving regulatory and policy frameworks, demonstration effects. These things are incredibly powerful beyond the additional dollars that have been brought in, and it's a tool that we hope to expand over the next few years as we increase our climate portfolio.
Thanks, Daniel. So let me now talk about something that you guys also talked about, which is adaptation. You know, adaptation is harder to fund than mitigation. You know, both of you said, oh, we don't need to fund mitigation, renewable energy mitigation anymore. What's difficult about adaptation? What's difficult for a DFI? And then what's difficult for private investors?
I should go first.
All of you have something to say. So yeah, sorry. So Marcela, go ahead.
I was going to say, I've been letting everyone take the first shot, which is always the hardest. I just get to come in and say, oh yeah, I agree with that.
Okay, Daniel,
so let me go first.
Now.
Let me go first. I mean, I would cheat a little bit and say that adaptation is hard no matter who's trying to fund it. You know, the global equivalence of 1 ton of carbon emitted outside in Washington, D.C. versus on an island in the Pacific, it doesn't make a difference. It has its global warming potential regardless. Adaptation is completely different. While DFC is a very large DFI in terms of assets under management, we are tiny compared to our peers on staffing, and particularly overseas staffing. We have a handful of business development managers and none currently in LAC, all in Africa and Asia, but we're building out that. And then we have some liaisons sitting in U.S. embassies with USAID. This is incredibly important because adaptation is highly localized. The solutions are sometimes not even known to the federal government, the national government, but only at the municipal or the subnational level. And particularly the case for developing sort of the historical data to prove the climate worthiness of your problem and your intervention is incredibly difficult without that local presence. So those are all important things to sort of name check at the beginning. Secondly, you obviously don't have a clear, a clear traditional return on investment case for some of these projects because obviously what you're trying to do is prevent a loss. You're not trying to create profit necessarily directly, but you're trying to prevent a loss. You're trying to prevent a rollback of development gains, ensure that people's livelihoods are not worse off tomorrow than they are before the intervention. And then on top of all that, you're trying to avoid what we call maladaptation or adaptation to the wrong circumstances or the wrong timelines or the wrong climate scenarios. So these are fraught with risk and fraught with pursuing solutions that seem like solutions today, but might not actually be solutions tomorrow. One of the most important things that we found is educating investors on what actually is an adaptation investment or what is actually a climate resilient investment. And this gets back to the context of the taxonomy and transparency. You know, they will remain nameless, but even my colleagues here at DFC have said, okay, now is this project mitigation or is it adaptation? As a climate professional, I almost want to open the window and jump out, but you know, this is just, that's another, I mean, just imagine someone in a completely private industry, a private investment sector who are just coming into this completely cold. And so education and understanding what makes an actual investment is incredibly important as well. And then finally, I would go back to something I said before, or what are the domestic incentives that might be at play here and beyond what you can get from concessional capital from DFIs. There are tax incentives, local tax incentives, employment incentives, and oftentings in adaptation and resilience investments, you know, the development impact, yes, fine, it is avoiding you know, the incidence and the frequency and the severity of climate impact. That's on the one side, but on the other side, it's typically jobs created, livelihoods made more resilient. And these are things that, again, talking about these second and third order effects are churning money through tax policy back into the local government, back into the national government, and governments are coming around to providing incentives in these areas as well. And we, DFC, we certainly hope that they continue to do so.
Thanks, Daniel. Okay, Marcela, Helen, do you want
Sure.
to? Yeah.
Yes, let me try and compliment Daniel, although I think that he gave a very comprehensive answer. When you look at the climate risks in the Latin America and the Caribbean region, you can see that there are a couple of sectors that are more vulnerable than others. The real estate sector, the agricultural sector, and I agree with Daniel in the sense of what he has mentioned about the challenges around adaptation. And actually, it's not, as Daniel said, it's not as the multilaterals. It's the world. If you look at the numbers at global level on the mobilization of capital towards climate change, 95% of that is towards mitigation and 5% to adaptation. And that just reflects the challenge that we have in front of us. Now, for those particular sectors, the real sector and the agricultural sector, we have been working very hard internally at the World Bank Group on trying to create tools that facilitate that as mitigation. So that is easy and it's standardized, and even though it's a very local context for some very specific sectors like these two, you can create a kind of a list of activities that you could put in place so that you adapt better than if you don't implement that. In the case of the real estate, for example, we have created the Building Resilience Index that we have tested already, piloted in the Caribbean, which is one of the most vulnerable subregions in Latin America and the Caribbean. And we have been putting together some criteria that could help new constructions or retrofit to be more resilient against climate change impact. So I think that that's a way of doing it, trying and standardize how to look at adaptation like this. We have followed the methodology that we have under the EDGE certification, which is a green building certification that IFC created some years ago. I think it was 10 years ago, and that is easy to use, and it's very friendly for the user, and that you just tick the activities that or the equipment that you are using, and it helps you quantify how much you are mitigating in terms of CO2 based on energy and water, for example. So it's very easy to use. So we are kind of translating that methodology into resilience, and I think it's a very good exercise. We are piloting it right now in the Caribbean and now piloting in other countries in the region, but I think it's worth having a look because obviously there is always a space for improvement, and would love to have any feedback that you have. But I think creating these kind of platforms or technologies that facilitate in a way, maybe it's not perfect, but at least it starts the process of thinking about how my developments could be more resilient. And same happens with agriculture. So there is a number of, or a list of activities that you could put in place so that you are more resilient to climate change. And that's a way of starting the work in this area.
Yeah, that sounds great. So I think you have the same kind of challenge. Earlier, you talked about the taxonomy challenge. And here we're talking about defining resilience, defining adaptation investments, because that's the first step before the underwriters can say, okay, we know this is green, this is not, we know this is resilient, this is not, we should fund this and not that, right? So Helen, let me bring you in to respond a little bit. And because I have an example from IDB that's similar to this from the ESG world, but Helen, please go ahead.
Yeah, no, I was just going to complement what I was saying about the taxonomy. So, the issue that, one greenhouse gas emission avoided is the same everywhere in the world that we were talking about, and resilience is more localized. There's an additional component that makes resiliency not necessarily difficult, but I think that focusing a lot on the numbers of financing, on how much we're channeling, may be misleading. And let me explain. Private sector investments, all 100% resiliency, is not that common. you will see a component of an investment that it has that impact of resiliency. And it could be resiliency of the specific project or resiliency of the community, right? And so you're not capturing that value within that specific amount that you're investing, because it could be smaller. And what we see when we talk to private sector clients in the region, especially in infrastructure, is that they see that making a road or making a specific asset resilient may be a 5% increase in the cost. So there is also this issue of a perceived very high incremental cost of resiliency, which the private sectors will tell you is not so much. Now, if we only talk about numbers, if we only talk about how much money is flowing to adaptation or resiliency, it will always be lower because it's only 5% of the project or maximum 10% of the project. So I think that here we do have to put value in making resilient assets and counting for that resiliency that we are achieving because we are adding that component into the investment. And so that's part of the conversation that right now we are having within IDB Invest in our process of capital increase that we're going now with a climate target, that we also have to start tracking and trying to understand what resiliency is and comparing. It's not that we're saying, let's stop counting how many dollars we're putting into the resiliency, but actually complementing the view of how many resilient assets we're supporting, because I think that will also get a momentum to increase and to put value in a way that then, as talking to the mobilization team, they tell me right now, that specific resilient asset may not have a pricing differential. It doesn't have an incentive necessarily. But if you start rewarding resiliency instead of punishing vulnerability, you may get somewhere.
Yeah, that's a very important point. I think here's the thing. If I think about how much I'm investing in mitigation, as you all said, my output is reduction in CO2 emissions, right? And I can measure that very easily. I can decide what price to put on it, but I can measure it easily. With adaptation, what's happening is not so much that it's not that I spent 5% more on the road cost. It's that because the road continues to operate through the disaster, then I've got some economic GDP impact, which is saved. So what I have to look at really, one thing is the asset, yes, the value of the road, but the going beyond that is what's the GDP or what are the flows of services which I protect as a result of protecting this road. So I think that's a more difficult question, but one that has to be asked, because there's no way you can evaluate adaptation unless you can ask, what am I protecting, and measuring what you're protecting, right?
If I may, for
yeah,
that, I think that
Marcelo.
Daniel gave a figure before about 1 to 4 in terms of for $1 you are mitigating 4 in terms of reconstructing something. And I think there are a number of figures out in the market about that specifically, which is quantifying the reconstruction of cities, infrastructure, disconnection because of the roads that can't operate and so on. So I think the case is there. The problem maybe is how we quantify the prevention of that. But I think that in terms of the impact of not doing it, I think it's quite clear already in the market. Just wanted to add that.
Yeah, no, important intervention there. The case is made at a large scale, high level. The GCA, the Global Center on Adaptation, they always put out the reports that show, hey, look, the cost benefit ratio of investing in adaptation is like 10 to 1. And that's true at some global level, but at the investment level, at the level of going in front of a committee, it's actually harder work, right? It's easier to do it at an economy-wide level, but much harder to do it for a particular project. And that's the work that sort of needs to accompany the best practices we have for getting through pipelines of projects. And that's where I think, Marcela, your tool on the resiliency index, right, for real estate you mentioned, and maybe also agriculture, that's where that tool can have real play.
Absolutely. And if I can add, I'm so sorry because I keep interrupting, but if I can add to that as well, supply chains is another way of looking at that. So it might be more difficult for an investor to decide on the numbers for adaptation of a road, and I get it. But imagine that we are talking about supply chain and we are talking about how you make a business sustainable, working in the supply chain behind you, and if it's resilient to whatever. Would it be a flooding, or would it be a draft, or whatever, right? So it depends on how you look at it, and I guess that looking at it from the business perspective, and that takes me to another point, which is very important, which is a natural capital. Sorry, I was thinking in Spanish. Natural capital, and how the ecosystem services actually make possible the operation of most of the sectors that we have in our economies. No, so if you look at that and you look at adaptation from that standpoint, and then you may be able to make a better case than if you are looking at the economy. Just wanted to add that.
Yeah, thanks, Marcel. Thanks for bringing up the issue of ecosystem services and natural capital. Very important. So we have a bunch of these topics. We're getting close to the hour, and I want to make sure that we have lots of the audience participation as well. So I know, Ignacio, you've been gathering the questions from the audience. So do you want to throw us out some audience questions, and then we can go back and try to wrap up as well?
Yeah, sure. The first one that we have is, how can the business case for adaptation be made better? One of the standing challenges is that the return is not as immediate or as predictable as what can be achieved with mitigation. That would be the first question.
Yeah, and I think this is a very good question. It's related to what we were just talking about, right? So I think so really, Daniel, you haven't spoken about this, so why don't you take this?
Sure, and actually this is sort of getting to the point of what I would say, which is one of the reasons why this is so difficult is because of the time lag. Financial institutions, the average tenor of a DFC investment is 7 years, 8 years. I mean, when you're talking about resilient infrastructure, that's just about enough time to build the thing, let alone let it operate for half a century. And when you're talking about acute versus chronic climate impacts, yes, fine, it's fantastic. Your island country or your port gets swamped by a hurricane once. Getting investment to prevent the next swamping by the hurricane is easy. But if you're talking about heat stress, drought, lack of precipitation, these chronic pressures, it's kind of like the boiling frog, right? How do you know when it's actually happened? And so that's a huge challenge that I think, we worked with an agro processor that was reliant on, based in the West Bank, reliant on almond and olive inputs to make their agro products. Now, you want to grow an almond tree in the desert, you're going to need an ungodly amount of water for that plant. And understanding through their smallholder network what the stresses and the risks were part of the process of structuring that investment. Luckily, we had a very climate conscious project applicant under that case, and he understood that, okay, fine, my operations might be climate resilient, but if all of my farmers supplying me with almond and olive inputs are getting wiped out because their crops are failing, then I'm in a lot of trouble. And we work with them to identify vulnerability and with some TA to help them build up adaptive capacity of their operation. So looking back at the supply chain is also very, very important. And it's about as predictable as you can get without having a crystal ball.
Yeah, so in some sense, in that example, you were looking at risk and minimizing risk rather than dealing with immediate return. And that's an equally sellable concept to investors, right?
Yes, and in fact, the part of the structure that we put together for this project was, an interest rate discount because of the extension services they provided to their smallholders, and that was part and parcel of the project, and that's kind of one of the sweetheart aspects of the deal.
That's great. That's great. Ignacio, you want to take another question? Because I know there are a whole bunch here.
Yes, of course. The second one, it's a little bit controversial, but this is the one. To what extent are the DFIs perpetuating dependency by adjusting their funding strategies to mitigate climate change effects in Latin America? And how can this power dynamic be altered?
Maybe I can start because that's not the purpose of DFIs, and we are actually in the markets to create the markets and facilitate that other investors come, right? So we create standards. We invest in the first thematic bonds so that the market can see that it's feasible, it's okay, it's good, it's a good instrument. And then we go out. We don't keep investing in green bonds. And that's the example that we are seeing in Latin America. We as IFC, and in some cases together with IDB, we have been the first investors in green bonds or in blue bonds. We have just done the first blue bond in Ecuador. And we are not there to stay. We are there to show this as a demonstrative example that this is possible. It is possible to see a bank issuing a blue bond, and then we welcome other investors to come, but the standard is there. The regulator knows how to handle that. The metrics, the transparency about it. So we are actually not creating markets to stay forever and ever. And in Colombia, for example, which is probably one of the most advanced countries in terms of thematic bonds, what we have seen is that we invested in the first 2 green bonds, and after that we have seen, I don't know, like 7 or 8. And that's the idea. And in those 7 or 8, we haven't been there. We were back when we were proving another instrument, sustainability bond, and we showed to the market that it is possible, and we walk out. So I don't think that we are actually aiming to extend our stay in the countries, but on the other, it's completely the opposite. We are there to demonstrate that this kind of investment is viable, and that the market is ready to receive any kind of investors.
Yeah, I think that's a very important point, especially on the private sector side, but even on the sovereign borrowing side, it's very clear that sovereign bonds, sovereign green bonds, sovereign thematic bonds, I saw a little bit of the issuance of the Uruguayan sustainability linked bond last year. There was some involvement from MDBs on capacity, knowledge transfer, networking, but there was 4 times oversubscription on the bond from ordinary private investors. I mean, from non-sovereign investors, right? So I think it's really about building the case and building the institutions and priming the pump, I think is probably the right metaphor. Ignacio, you want to take the next question?
Yes, the next one, we have a lot of questions. How should financial institutions address the potential for stranded assets in fossil fuel industries?
Yeah, okay, so stranded assets, we always get that question, right? So maybe Helen, do you want to address that?
Yeah, so part of the conversation right now in the adoption of Paris alignment, actually the 5th question of the methodology touches upon stranded assets. So basically, we do have to have an analysis of avoiding stranded assets to be able to move forward with an investment. It wasn't this far included, but now with Paris alignment, there's two actually very linked conversations. One is to avoid lock-ins of a specific technology that would prevent us from investing in a more renewable or climate-friendly technology. And the fifth question of the 5 questions that we have to ask is exactly that point, to prevent stranded assets.
Thank you, Helen. Ignacio, you want the next question? We're running out of time, so
Yeah.
and I know that we won't be able to answer everything, but why don't you pick a couple?
Okay, yes, this has 3 questions in one, so maybe this one should be the last one. Is can the panel speak a little bit about the state of blue carbon and nature/biodiversity markets and their role in adaptation and resilience? How real is this opportunity to support finance of ecosystem services and resilience, especially for islands? What are the risks to local communities?
Yeah, very important, and we didn't really get to discuss this topic, so I think, you know, maybe I'll just ask each of you to say a couple of words. Helen, why don't you go first?
Yes, thank you. So yeah, definitely blue carbon, but also nature-based solutions, biodiversity, especially in the context of what came out of COP15 last December, are very important for DFIs and for MDBs. Actually, we have signed a commitment as all of the MDBs for nature and planet in, where was it, COP26 in Glasgow, and we're implementing right now a taxonomy. It goes back again to a taxonomy, but we're defining a nature positive investment taxonomy with all the MDBs to be able to track how much money we are supporting for biodiversity investments. That's part of the conversation. But again, I think that the link between nature-based solutions and adaptation is a very important one, because many times what we see is that when we come down to what are the specific investments or interventions that will lead to resiliency and adaptation, have to do with nature-based solutions. And finally, in terms of specifically of island states and blue carbon, I think that the taxonomy that we have for blue bonds in particular, but also applying it to Latin America, we included with UN Global Compact a taxonomy that included the social aspect, because I think that the point of defining projects but forgetting about the social aspect is counterproductive in any of these projects, even with, you know, wind farms. So we do have to bring the social agenda together with the green agenda.
Yeah, thank you. Marcela, go ahead.
Sure, very difficult to do it in 1 minute, but just to complement Helen, IFC has launched a biodiversity finance guideline. It has recently also launched a Deep Blue, which is for blue carbon finance as well in coastal ecosystems, which I invite the audience to consult on the website. It's as easy as putting blue carbon IFC and you get the guidance for biodiversity finance IFC in your searcher, and you'll get there. So have a look at the standards, because as Helen is saying, we have been already researching a lot about this. I would say another thing, this is a very sophisticated audience based on the question, but I think that one of the big challenges in Latin America is knowledge. Here, it seems like we all understand all the technical topics, but outside it is very difficult when talking to an investor for them to understand what blue carbon is or what an ecosystem service is. So I think that one of the areas that we need to work a lot more is precisely knowledge and capacity building, and we are doing that in IFC through an initiative called the Green Banking Academy. But I know there are other academies in the market, but I think one of the most important things is finding these synergies so that we can talk to people about what all these means for them. What's the business opportunity there? And finally, we are very close to start the biodiversity finance taxonomy for Latin America. We are very happy to be working with a number of countries now. So you'll hear from that soon. Well, not soon. It'll take a year or so, but I think it's a very good step towards better understanding how to finance these particular sectors.
Thank you, Marcela. So we're over time. I'm going to just sort of end, with one last question for each of you, so that you leave us with some gems. This is being done at Columbia, the Climate School. We're always about trying to further knowledge, and thank you, Marcela, for bringing that in. Let me ask each of you, what's a skill, what's an important skill that we need in this area that we should make sure that we inculcate amongst our graduates, that you're working on to make sure that your analysts and your loan officers, your underwriters are acquiring, from your own day-to-day work. Just give us a skill that is in high demand that we should all be thinking about. So Helen, I'll start with you.
I'm trying to think what the specific skill would be, but I think it's the combination between finance and sustainability. I think you have a lot of engineers or maybe nature science experts that don't understand finance, and then people from finance that don't understand anything that has to do with climate. So having people that understand both worlds, that can speak both languages, is very critical.
That's really important. So I think you probably hit the nail on the head with that, and we have to get that to happen. We have to get these worlds to talk to each other. Thank you, Helen. Daniel.
Yeah, no, that's a great question, and I'm just to say I agree with Marcela, and I'm very impressed with the sophistication of the questions. And if I had to answer all of these on a test, I probably might not do so well. But look, I would say what I'm seeing, not just in the DFI space, but in private finance, is that they're desperate for climate risk analysts. They need people to understand and communicate, as Helen was just saying, what are the natural and climate impacts, what are those risks, and how do they translate to financial risk? And I would also extend that to not just physical risk, but transition risks. When we're talking about lock-in, carbon intensity, maladaptation, understanding not just what are the right options today and for the next 5 to 10 years, but what are the right options for 2050 and 2100. And you can only get that through solid risk analysis.
Thanks, Daniel. Yeah, this is top of mind for us, for Ignacio, right? I mean, this is what we've been working on for the past couple of semesters and an ongoing basis. So thank you, Daniel. Marcela, we'll let you have the last word on this. So please tell us,
Thank you.
Tell us what we need. What's our homework for today?
Well, I would say more than the homework, 3 strong messages for everyone. First, if you don't have regulation, you will have regulation. So regulation is coming. So get prepared in advance. And that means everything that Helen and Daniel have said, having the right capacity internally and all that. So be prepared. Second, there is a business case around climate finance. This is not for environmentalist people. This is for business people. So there is a business case for climate finance. Being that adaptation or mitigation, and we need to make our homework in terms of adaptation, but both, there is a business case. And third, not everything that is profitable is sustainable, but everything that is sustainable is profitable. So keep that in mind, because that's going to guide your business.
That's great. That's a really nice summation. Marcel, do you have time to come and teach a class?
I'd be more than happy. You know that I'm an assessor at Cambridge at the sustainable finance course that they have, and I completely loved it. So very happy to join you anytime.
Good. All right.
And let me clarify something. This is not mine. This is my niece's. I'm sorry.
That's fine. It can be yours. Listen, thank you so much. Helen, Daniel, Marcela, thank you for giving us your time, your knowledge, being so generous. Really appreciate it, and our audience appreciates it. And we hope to see you again soon in person here. Thank you, Ignacio, for putting it together, and thanks to the Columbia team for putting this together.
Indeed, thank you.
Thank you,
Thank you
Dr.
very much.
Daniel, Helen. Thank you very much. And thank you for the audience. Have a good one.
Take care.
Bye.
Bye.